Hey, welcome back. It's JWalter here. If you're looking to buy a house right now and you haven't locked in your mortgage interest rate yet, then it just got more expensive to buy a house. This is because mortgage interest rates have absolutely skyrocketed over the last week, reaching their highest levels in almost 2 years. In my opinion, this is the biggest housing market news that we have so far this year. Is this the end of the 3% mortgage interest rate? And what effects will these rising mortgage interest rates have on our housing market? In today's video, I'll break down what exactly is going on right now and what impacts this could have on home buyers and home sellers. And by the way, if you're looking to buy or sell a house from virtually anywhere in the US, then check out homeandmoney.com/Jason to get connected with a great real estate agent in your neck of the woods. And with that said, let's begin with today's video. So the average 30-year fixed rate mortgage in the US has surged to 3.64%. Rates haven't been this high since April of 2020. This is a dramatic shift because mortgage interest rates were near all-time lows last August when they were around 2.7%. So let's first have a brief look about why mortgage interest rates are skyrocketing. Over the past few weeks, we've seen record high inflation levels as well as record high COVID cases, and that is causing volatility in the bond and stock markets. Despite rising COVID cases, the increase of mortgage interest rates is consistent with recent statements from Fed Chair Jerome Powell that they will increase the federal funds rate 3 times this year, and they will also end their taper of treasuries and mortgage-backed security purchases earlier than planned. And this is important because experts are predicting that this could cause mortgage interest rates to increase this year. Rates could go higher than expected though, because I noticed that Goldman Sachs is predicting 4 rate hikes of the federal funds rate in 2022. And the CEO of JP Morgan stated that we could see more than 4 in order to combat rising inflation. Even though the federal funds rate is not tied directly to mortgage interest rates, ever since the Fed made their announcement a few weeks ago, bond yields have been increasing greatly, which has caused mortgage interest rates to increase as well. The closely watched 10-year U.S. Treasury yield rose above 1.7% last week, and current levels are at the highest levels we've seen since last March. And because the yield on the 10-year U.S. Treasury note is tied loosely to mortgage interest rates, that's why mortgage rates have been spiking lately. So here's something very important to note. If you're looking to buy a house right now, then a rise of mortgage interest rates decreases your purchasing power and also increases your payment as well. So for example, CNBC is reporting that for the median price home in the US of around $350,000, home buyers putting down 20% will now see a monthly payment of $125 more than they would have seen just 3 weeks ago. For those putting down less than 20%, their monthly increase will be even larger. Higher interest rates could throw some cold water onto these high home prices right now, and also home affordability could get worse for home buyers. So for example, a recent study by ATTOM found that home prices were less affordable in the fourth quarter of last year in 77% of the counties across the nation, and that is the highest percentage in the last 13 years. This is due to home prices rising at a much faster pace than wage growth. Home builders and also people looking to buy a brand new house are also facing challenges as well. According to the National Association of Home Builders, lumber futures prices have almost tripled in the last 4 months, and that has caused the average new single-family house to increase in price by more than $18,600. The impacts this has is that home builders will pass on these increased costs onto home buyers. And the prices of lumber have been skyrocketing due to ongoing supply chain bottlenecks, the doubling of tariffs on Canadian lumber, and wildfires in the West and in BC. And as I reported to you guys last week, the prices of brand new houses in the US have reached all-time highs. So the median sold price of a brand new home in November, which is the latest data that we have, surged to record high levels, and that was before the latest spike from lumber prices. So new home prices have now increased by about $100,000 since May of 2020. In general, what is propping up home prices right now across the nation, whether it's an existing house or a brand new house, is really twofold. Number one, and that's high demand from investors who purchase houses using cash and not mortgage loans. And number two, housing inventory is at record low levels, and that's one of the main reasons why home prices have been increasing. However, here's the big question though, will this increase of mortgage interest rates of about 1% since August, will that decrease home buyer demand? Or will it give people even more urgency to find a house to purchase before rates potentially increase further? Also, with all the news that mortgage interest rates have been increasing greatly, will this give homeowners more incentive to get their houses listed for sale and also to cash out all their equity? However, it's also possible that this spike of mortgage rates will also subside. There's also no guarantee that mortgage rates will increase further, and there's also no guarantee that home buyer demand will decrease as well. However, I'll be sure to keep you posted, of course, because I'll post the latest trends so you can make a more informed decision. So based on all these developments and this recent news that rates have been skyrocketing, here's my advice if you're looking to buy a house. If you haven't spoken to your loan officer yet this year, then I highly recommend that you reach out to him or her to discuss what potential impacts these rising rates have on you. As I mentioned before, when rates increase, your purchasing power decreases. So the loan amount that you were previously pre-approved for is likely to be a lower amount by now. A general rule of thumb is that for every 1% increase of interest rates, your buying power decreases by about 10%. This is very helpful to know because mortgage interest rates have increased about 1% since August of last year. So here's an example so you can see how this all plays out. So let's say a person was pre-approved to buy a home that was $444,000 based on a 3% interest rate. If rates were to increase to 3.5%, then their purchasing power goes down to $417,500. But if interest rates rose to 4%, then they may only qualify for $392,700. This decrease of buying power could mean that some people may no longer qualify to buy a house in the area that they want to purchase in. If that's the case, then some home buyers may have to adjust their home search in order to look in a different area. Or maybe now they have to look for a smaller house or even a fixer-upper. Others may decide to give up entirely until home prices or rates come back down. So what are your thoughts about all this? What do you think will happen to our housing market in 2022? Comment below. Also, check out that link if you're looking for a real estate agent referral in your neck of the woods. And also, if you got any value out of this video whatsoever, then please hit the like button. I greatly appreciate that. And also consider subscribing if you haven't done so already. Hope you have an awesome day and look forward to seeing you on the next video.